I think the thing that's fundamentally really important to understand, the strategist has a very tricky job. They obviously can't see the future, and they have to think big, and they have to think about, all right, it's July, what do things look like? Within the next 6 months, how do we end the year? What are some of the stumbling blocks that we might need to get past? And then what is like the chronological setup? You've got an earnings quarter about to get underway. This should be a fairly good earnings quarter if consensus is even close to what the numbers will end up being. There might be a surprise here and there with a tariff announcement, et cetera, et cetera. But like they have to skip to the end. And they have to do so in a nonsensical way. So they build this framework. And the framework has to have something to do with earnings and something to do with the rate outlook. And when you do that and you realize that one of the biggest risks to this market that we were all worried about, as you all know, the tariff thing, as you realize that that's sort of petering out and it's still with us and it still could produce shocks, but it's probably not going to be a worst case scenario, then what are you really worried about? Like, other than the typical exogenous event that no one can predict, what's the real thing that you're worried about? Because we got through the tax debate. Okay, This was a big one, and we got through it. We've gotten through several earnings quarters, the last 2 quarters, where the upside surprises were wild. But wild upside surprises. We got through the concerns about, is the AI theme going to have legs this year, or did everyone shoot their wad last year? Now we know that's not true. They have to spend just to maintain the spending they already committed to doing. So when you realize that that's the setup and which stocks are most important to the index level returns, that's where you get to a place where the analysts are saying, okay, no worst case scenario on trade, no problem with the tax bill, earnings are surprising to the upside, economy's holding up. Yeah, I'm at $6,900 for next year. Yeah, I'm at $6,100 for this year. Why wouldn't I be? And so I think that's the way you want to interpret this as somebody managing your own money. Why are they arriving at that conclusion?
I mean, the president's noticed the market, obviously. He posted on Truth Social a little bit earlier, quote, tech stocks, industrial stocks, NASDAQ hit all-time record highs, crypto through the roof, NVIDIA up 47% since Trump tariffs. Of course, that ignores the fact that the announcement of the tariffs crushed the stock market, but that's neither here nor there. He said the U.S. is back. He says no inflation. He wants rates lower. So it's gotten his attention too, Bryn. Are we supposed to continue to buy stocks?
I think so. I think the pain trade is people that are trying to, we'll say, time the market or sit in cash or overweight bonds. I think that while the market has largely become anesthetized to the tariff letters, the threats, et cetera, what's interesting, who hasn't become anesthetized to it is the Federal Reserve Chairman, Jay Powell. And so I think the irony, if we would actually just had 10% tariffs move on and just be settled out, I think the Fed would be set to start cutting rates ASAP because we can, right? And so if you look at the yield curve, there's plenty of room to cut rates. But the Fed is, Jay Powell clearly says that we don't know about tariffs. So I think that that's going to be, we'll say, the juxtaposition this year is between tariffs and rates. And I do think ultimately we'll get 1 or 2 rate cuts, which then goes into, if earnings are strong, we get 1 or 2 rate cuts. And to Josh's point, barring an exogenous event, that just should lead stocks higher. Whether it's in a linear path is anyone's guess, but it does feel like the market should be higher 6 months from now.
President should have gone even one better. Jason, I mean, NVIDIA's up 88% since the April low. It's even more impressive of what has happened. And by the way, as that stock got within 3 cents of another new high, and maybe it actually did hit it now, it was reiterated sell today. $100 is the target. Seaport Research, that's a 38% downside from here. What do you think about that? I mean, we've had some calls on some high-flying stocks of late to maybe take some of the, in some of the analysts might froth off, but I don't know what you think about this call.
Fine. Seaport's been busy over the last couple of weeks. I think they also downgraded Netflix recently. So what I would say about that call, first of all, data center momentum is still very much intact. Growing demand for sovereign AI, We've seen that with all the Middle East deals. And this Blackwell Ultra chip, from a production standpoint, is 50% stronger than the last iteration of it. So when I look at sales going forward, again, we saw a double in 24 and 25, right? Sales rising 52% in 2026, 22% in 2027. So yes, there is somewhat of a slowdown, but in my view, they still are the flag runner here, and I think that from an innovations perspective, they're still very much motivated to continue to run this story the way they have.
5 to 10% for stocks by year end from here. I've had people tell me 7,000 doesn't sound crazy. You're at 60, almost 6,300. 7,000 sound possible to you? Is HSBC correct to say buy more? They increased their overweight to equities further. They now prefer U.S. equities the most, which is interesting because you've had other calls too that the better value exists internationally. They say risk assets are set to remain supported with lower sensitivity to tariffs, and the Q2 reporting season is key catalyst.
Here's why I think 7,000 this year is a little bit of a stretch, although I'm certain that we'll get there soon enough. Everything Bryn said was right. The Fed is restrictive. The Fed does want to cut rates, but the problem is that because tariffs still exist, even if we're all ignoring them and most of the people on the floor are ignoring it, there's an August 1st date now that's out. So if you're a Fed chair and you're Chairman Powell, you're going to want to at least see 1 or 2 months of data to prove that the inflation isn't tariff-driven. So that takes us to September at best for a rate cut. We're not getting one in July. We may get one more at the end of the year. We could get 2, but it's going to be tough for the market to get to 7,000 this year if we're not having a pull forward on rate cuts.
I mean, but and by the way, if you have a 10,000, if you have a 10% increase between now and year end, you're basically there. You're on the doorstep of 7K. Josh, on the
rate cut doesn't matter.
The S&P.
Yeah, nobody should be baking in any specific number of rate cuts as a means to say stocks therefore are 8 to 10% undervalued. Like that should not be the bull case that we're going to get like accommodative policy because the employment situation is going to start to suck. Mm-hmm. That's just it. The logic is completely backwards. Nobody should root for medicine. Look, rates are probably too high. Let's all agree, okay? Probably, given the actual GDP growth rate and maybe given some of the softening in initial claims, which honestly is not that bad, but fine. Let's just say they were a little bit restrictive. Are they 200 basis points over where they should be? No, I don't think anybody would say that. And you didn't need rate cuts this entire rally. So what are you begging for Sudafed for? I don't understand it. So that's number one. Number two, more important than any of that, is whether or not the CapEx theme holds up, because that's what's driving earnings, and that's what's driving the $2, $3, $4 trillion stocks that matter the most to the market cap. By the way, also driving the financial sector, all the M&A, all the venture-backed startup stuff, the IPO window being flung open, all of it is coming from CapEx. And I'll tell you something else that's not popular, but I'm going to say it. It's also driving the consumer spending. I watched TV this morning. The Delta CEO was on Squawk talking about the K-shaped recovery. They had 3 different guests in a row, Bank of America, talking about it. Look, it's the top 20% of the country that's accelerating their spending. They're not doing that magically in a void. They're doing that because of what their brokerage accounts look like. Every morning when they open up the app, they're doing that because of what their 401k balances look like. That's why they're accelerating their spending on travel and luxury and services. So if you tell me that you think the AI CapEx tailwind holds up, then the domino effect for all of that is, well, the consumer spend is going to be fine. Okay. The leisure economy is going to be fine. Retail is going to be fine. Restaurants going to be fine. And that's the way that you need to think. Not, oh, my God, I need my rate cut. What's wrong with you?